It was late 2014. A journalist at the Zeitung, one of Germany's most respected investigative newspapers, received an encrypted message on his phone. The text was short, calm, and almost impossibly precise. Someone claimed to have access to internal documents from a law firm in Panama. Not a few documents, not a folder, millions of files. Bastian Obermeier, the reporter who received that first contact, later described the moment as one that stopped his breathing. The source, who introduced themselves only with the pseudonym John Doe, was not asking for money. They were not asking for protection in exchange for information. They were asking for just one thing: to be heard. What followed was one of the most consequential exchanges in the history of journalism. Over weeks and then months, the files came through. Transfer after encrypted transfer. Faint signals of a vast underworld. By the time the full picture became clear, Obermeier and his colleague, Frederick Obermeier, had received a volume of data so enormous it required an entirely new way of thinking about investigative journalism. 2.6 terabytes, 11.5 million documents, emails, contracts, passport copies, bank transfers, corporate registration filings. The complete internal archive of one firm, stretching back nearly 4 decades. The firm was called Mossack Fonseca, and what those documents would reveal to the entire world on April 3, 2016, was not simply a list of names. It was the anatomy of a parallel financial universe that had operated for decades, fully visible to those inside it, and almost entirely invisible to everyone else. To understand what the Panama Papers were, you first have to understand how offshore finance works. Not as an exotic criminal phenomenon, but as a legal and financial architecture that exists openly in dozens of jurisdictions around the world. An offshore company is, in simple terms, a legal entity registered in a jurisdiction different from where its owner lives or operates. There are entirely legitimate reasons a person might create such a structure: separating personal assets from business assets, protection against civil litigation, simplifying the administrative burden of international operations, estate planning, legal tax optimization. These are all recognized and frequently used financial tools. Panama, the British Virgin Islands, the Seychelles, the Cayman Islands, the Bahamas, Luxembourg, and even the state of Delaware in the United States all serve as jurisdictions offering favorable conditions for company formation. Minimal disclosure requirements. Nominee directors who lend their names to companies without exercising real control. International banking access. Bearer shares that transfer ownership without documentation. The creation of a company in the British Virgin Islands can be completed in a few hours and costs just a few $100s. None of this, by itself, is illegal. That needs to be said clearly and repeated, because it is one of the most important concepts in understanding what the Panama Papers actually showed. Offshore companies are legal. What is done with them can be legal or illegal. The line between the two is the crucial question. The mechanism that makes offshore structures so powerful is layering. Imagine Company A, registered in Panama, is the legal owner of a London apartment. Company A is itself owned by Company B, registered in the Seychelles. Company B is administered by nominee directors whose names appear on official filings, but who have no real connection to the actual owner. Company B is, in turn, controlled through a trust structure governed by a Swiss lawyer acting on behalf of an unnamed client. The true owner, the person who actually controls the apartment, the person who actually benefits from its value, is what is called in international finance the beneficial owner. And in this structure, that person's identity is nowhere in any public document. This is not a hypothetical. This is a structure, Mossack Fonseca, and dozens of firms like it built by the hundreds of thousands, across a period of decades for clients on every continent. And it is this structure, multiplied by a number almost too large to comprehend, that the Panama Papers brought into the light. Mossack Fonseca was not a household name before April 2016. That was, in many ways, precisely the point. But within the specialized world of global offshore finance, it was one of the dominant players. At its peak, the firm was described as the world's fourth largest provider of offshore financial services, responsible for acting on behalf of approximately 300,000 companies, with offices in over 42 countries and approximately 600 employees spread across the globe. The firm was founded in 1977 by Jürgen Mossack, a German-born lawyer whose father had emigrated to Panama after serving in Hitler's Waffen-SS during the Second World War. Mossack grew up in Panama, studied law, and built a practice centered on international commercial work. In 1986, he was joined by Raymond Fonseca Mora, a Panamanian lawyer with a very different public profile. Fonseca was educated in law and political science at both the University of Panama and the London School of Economics. He later became a prominent novelist and a leading figure in Panamanian political life, serving as an advisor to President Juan Carlos Varela. Together, Fonseca once mused in an interview, they had created a monster. The firm specialized in commercial law, trust services, investor advisory, and what it euphemistically called international business structures. It also offered intellectual property protection and maritime law services. But the heart of its business was something far more specific. An internal memorandum later revealed in the Panama Papers leak contained a frank assessment of the firm's work. 95% of the company's work, it stated, consisted of selling vehicles to avoid taxes. This was not a secret to insiders, but it was rarely stated with such clarity. The firm operated in a space that required meticulous legal craftsmanship, but also, as the documents would show, a consistent willingness to look the other way. Mossack Fonseca did not simply register companies. It provided nominee directors, managed complex multi-jurisdictional structures, helped clients move assets through dozens of intermediary steps, and in at least some cases, actively worked to hide the relationships between its operations in different countries. The firm's Nevada subsidiary, for example, operated under the name MF Corporate Services Nevada Limited. When Mossack Fonseca faced a subpoena in a U.S. District Court in Las Vegas, related to 123 shell companies linked to a crony of Argentina's former president, Jürgen Mossack himself testified under oath that MF Corporate Services Nevada had no affiliation with the Panamanian Mossack Fonseca. The Panama Papers showed that this was false. The Nevada operation was a wholly owned subsidiary, and internal emails showed employees attempting to delete electronic records and physically remove paper documents from the office, with one email noting that when a staffer named Andres came to Nevada, he cleaned up everything and brought all documents to Panama. This was the firm at the center of the largest data leak in the history of journalism. The identity of the person who leaked the Panama Papers has never been definitively established. They communicated from the beginning under the pseudonym John Doe, using encrypted channels, and took extraordinary precautions to avoid detection. Bastian Obermeyer has said that communication with John Doe required a level of operational security he had never previously encountered in his career. What is known is this. In 2014, an individual began transmitting data from Mossack Fonseca's computer systems to Obermeyer at the Süddeutsche Zeitung. The transfer was not a single event. It was a process that continued over months, building in volume until the full 2.6 terabytes had been delivered. The source verified each batch of documents and provided context to help journalists understand what they were looking at. Then, in May 2016, approximately 6 weeks after the Panama Papers were published, John Doe broke their silence in a different way. They issued a public statement of approximately 1,800 words, a document that read not like a confession, but like a manifesto. In it, John Doe outlined their motivations with cold clarity. The statement said, for 50 years, executive, legislative, And judicial branches around the globe have utterly failed to address the metastasizing tax haven spotting. Earth's surface. Income inequality, John Doe wrote, is one of the defining issues of our time. The statement described corruption not as an aberration, but as a structural feature of modern global finance. John Doe also addressed the question of legality directly. They stated that they had not provided the documents to any government agency and had not personally profited from the transaction. They said their motivation was a belief that the public had a right to know. They also expressed frustration that the mainstream financial press had not pursued these stories more aggressively, and suggested that captured regulators and cowardly politicians had allowed the offshore system to persist for decades despite its obvious harms. Years later, John Doe gave an interview to a German publication in which they expressed being astounded by the scale of the investigation's success, while also noting that much more remained to be done. Their identity has never been publicly disclosed. They remain, in the full sense of the word, anonymous. When Bastian Obermeier and Frederick Obermeier first began receiving the data in 2014, they quickly realized that no single publication, no single team of journalists, and no single country's resources could handle what they were looking at. In February 2015, the Süddeutsche Zeitung made contact with the International Consortium of Investigative Journalists, known as the ICIJ, a Washington-based non-profit organization dedicated to supporting cross-border investigative work. What followed was more than a year of one of the most complex and secretive collaborative operations in the history of the news media. The ICIJ, led by its director Gerard Ryle, assembled a team that would eventually include more than 370 journalists from over 100 news organizations in 80 countries. The Guardian in the United Kingdom, Le Monde in France, BBC, NDR and WD are in Germany, La Nation in Argentina, The Hindu in India, Haaretz in Israel, Der Spiegel in Germany. More than 100 other organizations spanning 6 continents, all working in coordinated secrecy. The challenge was not merely the volume of data, it was the nature of it. 11.5 million documents in a variety of formats, in multiple languages, spanning 4 decades, containing references to hundreds of thousands of companies and individuals, connected through a maze of cross-ownership structures and jurisdictional layers. To make this comprehensible, the ICIJ and its partners developed data journalism tools specifically for this investigation: searchable databases, network visualization software, pattern recognition systems that could identify connected entities across thousands of documents. It was, in the words of Gerard Ryle, probably the biggest blow the offshore world has ever taken, not just because of the revelations, but because of the methodology required to produce them. The entire project was kept secret from the broader public until April 3, 2016. During that year-long period, hundreds of reporters in dozens of countries were all working with the same documents, building the same picture, coordinating their publication to occur simultaneously around the globe. No information leaked prematurely. No government was tipped off in advance. It was a feat of collective operational discipline that the journalism industry had never previously achieved at this scale. At 6 o'clock in the morning Central European Time on April 3, 2016, the stories went live simultaneously in publications across the world. By the end of that day, the Panama Papers had become the dominant news story on the planet. The documents detailed the operations of more than 214,488 offshore entities connected to individuals and organizations in more than 200 countries and territories. Among them were 12 current or former heads of state and government, at least 128 other politicians and public officials, more than 60 of their relatives and close associates, members of the international football governing body, FIFA, companies that had at various points been sanctioned by the United States Treasury, and a company believed to hold proceeds from the 1983 Brinksmat robbery in London, the largest gold heist in British history. But the document that most immediately commanded global attention was a paper trail leading toward the Kremlin. The Panama Papers revealed a network of offshore shell companies that had moved, according to ICIJ investigators, at least $2 billion through banks and shadow structures in transactions connected to people in the inner circle of Russian President Vladimir Putin. At the center of this network was a man named Sergei Roldygin, not an oligarch, not a government official, a classical cellist and conductor, the principal cellist of the Mariinsky Orchestra in St. Petersburg, and one of Vladimir Putin's closest personal friends since their youth in Leningrad in the 1970s. Roldygin is the godfather to Putin's eldest daughter. He has performed at the president's official residence. He has given interviews that humanized Putin's public image. In 2014, when the New York Times asked him about his financial affairs, Roldygin said simply, "I don't have millions." The Panama Papers told a very different story. In the documents, Roldygin appeared as the owner of offshore companies registered in the British Virgin Islands and Panama, including firms called International Media Overseas, Senet Overseas, Sunbarn Limited, and Sandalwood Continental. These companies had received tens of millions of dollars in wire transfers from other entities with links to Russian state banks. One of Roldygin's companies obtained a significant ownership stake in one of Russia's largest television advertising firms. Another gained indirect management control over a major shareholder in Kamaz, Russia's largest truck manufacturer. Documents were backdated. Rights to multi-million-dollar loans were transferred between offshore companies for $1. Complex financial arrangements moved value in directions that consistently benefited the network and its members. ICIJ investigators and their partners concluded that the evidence strongly suggested Roldygin was acting as a frontman, a stand-in whose name appeared on documents while the actual beneficiary remained hidden. When reporters from Novaya Gazeta, ICIJ's Russian media partner, met Roldygin backstage after a concert in Moscow, the cellist declined to answer questions about the offshore companies. He told them he needed more time to determine what he could say. Putin later addressed the matter publicly, saying that Roldygin was a minority shareholder in one of their companies and that most of the money had been used to purchase musical instruments. The Kremlin called the Panama Papers an information attack. Separately, banking records obtained by the OCCRP showed that an offshore company linked to Roldygin had received money at approximately the same time that another entity connected to it was being used in what investigators described as the theft of $230 million from the Russian government, the case at the center of the Magnitsky affair. Sergei Magnitsky, the Russian lawyer who uncovered that theft, was arrested in 2008 by the same officers he had accused of committing it, and died in custody in 2009 after being denied medical care. His case became one of the most internationally scrutinized human rights matters of the post-Soviet era. The Panama Papers added new layers to that story. The network connected to Putin was not the only story of this scale in the documents. The files also exposed offshore companies controlled by associates of Ukrainian President Petro Poroshenko, including evidence that he had maintained control of his candy business through an offshore structure, even while publicly claiming to have divested it after taking office. The documents implicated figures connected to the King of Saudi Arabia. They showed offshore holdings linked to the President of Azerbaijan and the Prime Minister of Pakistan. They contained the financial footprints of Lionel Messi, the Argentine football star, and his father, who were listed as the owners of a Panamanian company called Mega Star Enterprises Incorporated. Messi was already facing a separate tax evasion case in Spain at the time. The documents added a new company name to the list of offshore structures known to be linked to him. And then there was Iceland. In a country of approximately 320,000 people, political scandals tend to land differently than they do in larger nations. Iceland is a place where almost everyone knows almost everyone else. It is also a country that had lived through one of the most traumatic economic collapses in modern history. In 2008, Iceland's three largest banks, Landsbanki, Glitnir, and Kaupthing, collapsed simultaneously under the weight of debt that had grown to 9 times the country's entire gross domestic product. The currency collapsed. Inflation surged above 20%. The IMF was called in. Thousands of families lost their savings. The crisis remains a defining national memory. Into this context, Sigmundur David Gunnlaugsson had risen to become Prime Minister of Iceland in 2013. At the age of 38, one of the youngest people ever to hold the office. He was a champion of Icelandic financial sovereignty. He had positioned himself publicly as the defender of ordinary Icelanders against foreign creditors who demanded repayment, famously calling some of those creditors vultures. The Panama Papers revealed that in December 2007, Gunnlaugsson and his wife, Anna Sigurlaug Pálsdóttir, a wealthy heiress, had jointly purchased an offshore company from Mossack Fonseca. The company was called Wintris Incorporated, registered on the island of Tortla in the British Virgin Islands. The company held millions of dollars in bonds in Iceland's 3 major banks, the very same banks that would collapse within months of the company's creation, the very same banks whose creditor negotiations Gunnlaugsson would later oversee as Prime Minister. When Gunnlaugsson entered Parliament in April 2009, he did not declare his ownership stake in Wintris, as Icelandic parliamentary rules required. On the last day of 2009, just days before a new law was passed tightening disclosure requirements for members of Parliament, he sold his half of the company to his wife for $1. His wife's representatives later said the company had always belonged to her alone, that a bank error had resulted in her husband's name appearing on the original documents. Gunnlaugsson himself said the company was simply a holding vehicle for his wife's inheritance, that it had never been used for tax avoidance, and that all taxes on it had always been paid in Iceland. When the Panama Papers were published on April 3, 2016, and the story of Wintris emerged, an ICIJ media partner in Sweden, SVT, arranged an interview with the Prime Minister on camera. The interview was one of the most extraordinary scenes in modern political journalism. When the Swedish reporter asked Gunnlaugsson directly about his connections to Wintris, the Prime Minister stumbled. He said his wife had sold a part in a family company, that a bank had made some arrangement, that he was unsure how these things worked. He then said the interviewer was making something suspicious out of nothing, and he got up and walked out. The camera kept rolling. That clip was watched by millions of people within hours of being posted online. Back in Iceland, the public reaction was immediate and visceral. Thousands of people gathered outside the Alþingi, Iceland's parliament, the largest demonstrations the country had seen since the 2008 financial crisis. Protesters threw yogurt, eggs, and bananas at the building. The bananas a symbolic reference to the Banana Republic they feared their country was becoming. More than 26,000 people, nearly a tenth of the entire population, signed a petition demanding the Prime Minister's resignation. On Monday, April 4th, Gunnlaugsson told Parliament directly, "I have not considered resigning, nor am I going to resign because of this matter." On Tuesday, April 5th, he resigned. He was the first political leader in the world to fall as a direct consequence of the Panama Papers. He would not be the last. The Panama Papers landed in different political contexts with different consequences, but the pattern was consistent. In Pakistan, the documents did not name Prime Minister Nawaz Sharif himself, but they named 3 of his adult children, his daughter Mariam Nawaz, and his sons Hassan and Hussein Nawaz. The ICIJ found that they were listed as owners or had authority to authorize transactions for several offshore companies, including Nesco Limited, Nielsen Holdings Limited, Cooler Group Incorporated, and Hangen Property Holdings Limited. These companies owned luxury flats in Mayfair and Park Lane in London, some of the most expensive real estate on earth. The properties were used as collateral for loans, totaling up to $13.8 million. The assets had not been declared on the Sharif family's official wealth statements. The opposition, led by Imran Khan, filed a petition with the Supreme Court. The court ordered an investigation. A joint investigation team was formed, given sweeping powers to examine the family's finances. What the investigators found extended well beyond the original Panama Papers revelations. They uncovered an undisclosed work permit held by Nawaz Sharif for a company in the United Arab Emirates, a violation of Pakistan's constitution. They found that a key document his daughter Mariam submitted to the court, a 2006 trust deed claiming to show she was a trustee rather than the owner of the offshore firms, had been typed using the Microsoft font Calibri. Investigators pointed out that Calibri had not been made commercially available until 2007. The document appeared to have been fabricated. This episode became known as Funkgate. In July 2017, the Supreme Court voted unanimously to disqualify Nawaz Sharif from the prime ministership. He was barred from holding public office. A judge said in open court that Sharif was no longer eligible to be an honest member of parliament. The following year, an accountability court sentenced him to 10 years in prison and fined him more than $10 million in connection with the London apartments. His daughter received a 7-year sentence. His son-in-law received 1 year. All of them denied wrongdoing and described the proceedings as politically motivated. Nawaz Sharif became the second head of government in the world to lose his position as a direct consequence of the Panama Papers. In Britain, the fallout was of a different nature, but not without political consequence. The documents revealed that Ian Cameron, the late father of then Prime Minister David Cameron, had been a co-founder and shareholder of Blairmore Holdings Incorporated, a Panama-based offshore investment fund that had operated for more than 30 years. Blairmore had been specifically structured to ensure that it never paid tax in the United Kingdom, employing nominee directors and administrative staff in the Bahamas to maintain the fiction that the fund was managed from outside Britain. David Cameron initially refused to comment on whether he had personally benefited from his father's fund. Under sustained pressure from journalists and the public, he eventually disclosed that he had owned shares in Blairmore, sold them before becoming Prime Minister, and paid all applicable taxes in Britain on the sale. He acknowledged the offshore structure was not something he was proud of. He also acknowledged publicly for the first time that Blairmore had been designed to avoid paying UK tax, a statement that sat awkwardly alongside his own government's rhetoric about the moral duty to pay taxes and his public criticism of aggressive tax avoidance. Cameron was not forced from office, but he spent the week after the Panama Papers publication in a sustained political crisis at a moment when his government was already deeply divided over the coming referendum on European Union membership. Many observers later noted that the Panama Papers had further damaged his authority in the final weeks before the Brexit vote. One of the most important things the Panama Papers revealed was not any individual transaction, but the systemic architecture that made all of those transactions possible. The documents did not show a series of isolated bad actors operating outside the system. They showed a system. At the center of that system were offshore law firms like Mossack Fonseca, which acted as the factories, producing the corporate vehicles through which assets could be held, moved, and obscured. But the files also showed, with unusual clarity, the role played by large international banks. The Panama Papers contained records of nearly 15,600 shell companies set up by banks for clients seeking financial privacy. Among the most prominent creators of these structures were two of the world's largest banking institutions, UBS and HSBC. These were not small or marginal operators. These were institutions subject to the oversight of some of the world's most powerful regulatory bodies, institutions that had publicly committed to anti-money laundering compliance frameworks, institutions that had been fined billions of dollars in previous years for precisely these kinds of failures. The Panama Papers showed that the formal compliance structures and the operational reality were not the same thing. The documents also revealed patterns of deliberate concealment. In the Nevada episode, Mossack Fonseca employees were documented attempting to erase electronic records and physically remove paper documents to prevent investigators from accessing them. Jürgen Mossack had testified under oath about the relationship between his firm and its American subsidiary in a way that the documents showed to be false. The firm also regularly offered to backdate documents for clients. By 2007, this practice had become so routine that internal emails show employees discussing the creation of a formal price structure for the service. Clients would pay $8.75 for each month of backdating required. For the researchers and economists who were granted access to the ICIJ database after publication, the Panama Papers represented something rare and extraordinary. A detailed real-world map of a system that had previously existed almost entirely in the dark. The documents connected individuals to companies, companies to other companies, assets to jurisdictions, and transactions to dates, in a chain of evidence that allowed investigators to trace the movement of money in ways that no public record had ever made possible. The Tax Justice Network, a financial transparency coalition, and dozens of academic institutions later produced analyses drawing on the Panama Papers data that changed the empirical understanding of how much wealth was being hidden offshore, how it was being structured, and who was benefiting from it. The reaction to the publication of the Panama Papers was, in the words of CNN columnist Frida Giedis at the time, an earthquake. She added that the aftershocks would continue for months, even years. She was right. Within days of publication, police had raided Mossack Fonseca offices in Panama City, Lima, and San Salvador. By the end of 2016, governments and institutions in 79 countries had opened 150 separate inquiries, audits, or investigations linked to the law firm, its intermediaries, or its clients. Hundreds of individuals and companies were placed under scrutiny. Tax authorities in Australia announced they were investigating more than 800 wealthy people for possible tax evasion linked to their dealings with the firm. The firm that had spent decades building an empire of silence began to crumble. In February 2017, Panamanian authorities arrested both Jürgen Mossack and Ramon Fonseca. In October 2020, prosecutors in Cologne, Germany, issued international arrest warrants for both founders, charging them with accessory to tax evasion and forming a criminal organization. In March 2018, Mossack Fonseca announced it was shutting down permanently, citing the economic and reputational damage caused by the Panama Papers, along with what it described as unusual actions by Panamanian authorities. After nearly 4 decades of operation, in which it had created corporate vehicles for hundreds of thousands of clients across more than 200 countries, the firm closed its doors. But the larger legal dimension came in June 2024, when a Panamanian judge acquitted all former Mossack Fonseca employees, including both founders, citing insufficient evidence and problems with the chain of custody of the leaked evidence. The acquittal was controversial. Legal analysts noted that it highlighted one of the inherent complications of building criminal prosecutions on the basis of evidence that had itself been obtained through a data breach. The question of what was done was one thing. The question of what could be proven in court was another. The financial consequences for exposed individuals and companies were substantial. The Panama Papers wiped out an estimated $135 billion in market value from nearly 400 publicly traded companies with direct exposure to the revelations. According to academic analysis, governments around the world began recovering back taxes and penalties. By 2019, the ICIJ reported that the global tally of money recovered had exceeded $1.2 billion. Great Britain had recovered the most, $253 million, followed by Denmark at $237 million, Germany at $183 million, Spain at $164 million, France at $136 million, and Australia at $93 million. Colombia recovered $89 million. the highest amount for any South or Central American country. By 2021, the figure had risen to more than $1.36 billion, and the ICIJ acknowledged that this almost certainly understated the true financial impact, given that many governments had declined to share complete data. The legislative response was extensive and, in some respects, transformative. In the United Kingdom, the government created a public register of the beneficial owners of companies, a commitment that the Panama Papers accelerated into implementation. At a global anti-corruption summit in London in May 2016, at which the Panama Papers featured prominently, Nigeria, Ghana, Kenya, and Afghanistan committed to create similar registries. The European Union published a blacklist of 17 tax havens. Canada committed to creating a beneficial ownership register and increased the Canada Revenue Agency's budget by more than $500 million. By February 2020, 81 countries had passed laws requiring ownership information to be registered with national governments, more than double the number from 2 years earlier. In the United States, Congress passed the Corporate Transparency Act in January 2021, requiring company owners to identify themselves to the Department of the Treasury. The Tax Justice Network described the progress in the years following the Panama Papers as considerable but incomplete. The offshore system did not end. The fundamental architecture of financial secrecy that the documents exposed was not dismantled, but it was placed under a level of public and regulatory scrutiny that had not previously existed, and the pressure that scrutiny generated produced real, measurable change. The figure at the center of the Panama Papers, the person whose decision to transmit those 11.5 million documents created all of this, remains unknown. John Doe has never been publicly identified. In their 2016 statement, they described themselves as neither a libertarian nor an anarchist. They were not against financial privacy as a concept. They were against a system in which financial privacy was available to the powerful as a tool for avoiding accountability, while ordinary citizens paid taxes that those at the top of the wealth distribution had structured themselves to avoid. John Doe's statement explicitly addressed the question of legality. They wrote that the Panama Papers represented a case where the law itself was the problem. When the legal structures that exist to govern financial behavior have been captured by the interests of those they are supposed to regulate, the distinction between legal and illegal loses much of its moral content. The question is not only whether something is technically permitted, but whether it should be. That framing, whether one accepts it or not, is important to understanding the impact of the Panama Papers. The revelations were not, for the most part, about people breaking laws. They were about people using laws, legal structures that had been deliberately designed to enable financial opacity, to accumulate and protect wealth in ways that were invisible to tax authorities, to political opponents, to journalists, and to the public. The laws were working exactly as they had been designed to work. The question raised by the Panama Papers was whether they should have been designed that way. It is worth pausing on the mechanism by which John Doe's action became possible. Mossack Fonseca's data security, despite the firm's decades of operation and the sensitivity of the information it held, was described by cybersecurity expert Chris Kubeka, who examined the firm's systems after the leak became public, as catastrophically inadequate. The firm's client login portal was found to be running 4 different government-grade remote access Trojans. There were critical vulnerabilities throughout the infrastructure. Too many open ports, direct internet access to the archive server, a system apparently designed for accessibility, not protection. The paradox at the heart of the offshore world was that the same opaque legal architecture that had been constructed to make its clients invisible had rested on a digital infrastructure that was, to a determined and knowledgeable person, deeply vulnerable. In a subsequent interview with the German publication Der Spiegel, several years after the original leak, John Doe described being astounded by the success of the investigation. But they also expressed continued frustration. The system, they said, had changed less than they had hoped. The offshore world had adapted. New jurisdictions had emerged. New structures had been devised. The battle for financial transparency was not over. The Panama Papers were the largest data leak in the history of journalism at the time of their publication in April 2016. They have since been succeeded in volume by the Pandora Papers in 2021, and other subsequent investigations built on similar methodologies. The ICIJ has continued to publish investigations using data from different sources and different contexts, each one adding to the accumulated public record of how global offshore finance operates. But the Panama Papers remain the reference point, not simply because of their scale, though the scale was extraordinary, not simply because of the political consequences, though those consequences were historic, but because of what they revealed about the nature of a system. Edward Snowden described the Panama Papers as the biggest leak in the history of data journalism. Gerard Ryle of the ICIJ called it probably the biggest blow the offshore world had ever taken, because of the extent of the documents. Transparency International UK said the papers demonstrated not a fundamentally benign system that had been eroded at the edges by a few criminals, but a system with deeply ingrained criminality that operated in the interests of the world's corrupt elite. That judgment is contested. Mossack Fonseca, before its closure, consistently maintained that it had operated legally and that its clients were responsible for what they did with the corporate structures the firm created. Raymond Fonseca compared the firm to a car factory, arguing that it bore no more responsibility for how its products were used than an automaker bore responsibility if one of its vehicles was used in a robbery. The legal system in Panama, at least at the level of national courts, ultimately agreed, acquitting all personnel associated with the firm. But the legal judgment and the moral judgment are different questions. And the Panama Papers did something that no legal proceeding had ever done. They allowed ordinary people in every country to see with their own eyes how the system functioned, not through the interpretations of politicians or the summaries of regulators or the conclusions of courts, but through the actual documents, the actual emails, the actual corporate filings, the actual instructions sent between lawyers and bankers and directors and clients, in the actual words that were used at the actual moment they were written. 11.5 million documents, 2.6 terabytes of data, more than 370 journalists from 76 countries, one anonymous source who believed the world had a right to know. The Panama Papers did not expose a secret. They exposed a system of layered companies and nominee directors and correspondent banks and trust, structures and compliant jurisdictions, and captive regulators and cooperative politicians that had existed for decades, operating in the open, hiding in the language of corporate law, sheltered by the complexity of jurisdictional boundaries, invisible because its architecture had been specifically engineered to produce invisibility. Consider what that invisibility cost. The IMF estimated that corporate profit shifting alone costs governments in developing countries roughly $213 billion a year. That is money that does not build hospitals, does not fund schools, does not repair roads, does not pay for social safety nets. It moves instead through nominee-directed shell companies in the British Virgin Islands, through correspondent accounts in Luxembourg, through trust structures in the Seychelles, into the personal wealth of people who already have more than they will ever spend. The Panama Papers gave that abstraction a human face. It gave it a name. It gave it a document number, a company registration date, a bank transfer record. It made the invisible visible. And for a brief, extraordinary period, beginning on the morning of April 3, 2016, when hundreds of journalists in dozens of countries simultaneously published what they had spent more than a year learning together, that invisibility ended. What happened next was the subject of a decade of legal proceedings, legislative battles, political consequences, and ongoing investigations. What remains is the question that the documents themselves posed. Whether the world that was revealed in those 11.5 million files is the world we choose to continue living in, or whether the act of seeing it clearly was itself the first step toward building something different. The answer to that question is still being written.